First, just a quick risk disclosure. All trades and investments involve the risk of financial loss. The value of positions can go down as well as up. Past performance does not guarantee or predict future results. And a bit about me. This is my 20th year now trading these markets. It's been an amazing way of connecting with the economy, with the financial world, with what's going on in individual companies. It's provoked a lot of learning. And, first, as I got started, I was a much more discretionary trader and it was a lot more trial and error. But as time went on, I became more systematic. And I think that's an important area to look at. The advantages of systematic trading versus discretionary trading. Now, don't get me wrong. Some people are fantastic discretionary traders, more power to them. But I do think that putting data on your side more and more where you can help you gain an edge over time. That's also why I build a lot of the tools that I build. It's all about trying to put data on our side. So when we think about trading, probabilistic outcomes, if we can put them in our favor as traders more consistently, then we can build that discipline and confidence from doing so, because we'll start to believe in the methods that we employ more because they show results. Whereas when one is discretionary, it's much more subjective as to whether or not those outcomes can be made more consistent. It's all much more about emotion and psychology and mindset. So for me, over time, I started off discretionary and then I leaned much more into systematic trading. And over the last several years, I've focused on not only trading in a systematic manner, but also employing systematic trading into how I build tools to help others be able to use that. And, we can either spend hours and hours poring over charts and data, which is fine, or we can try to make it more programmatic and automated and algorithmic to lessen the time that we're spending doing that and focus on what little time we have to be able to interact with markets, to be able to sharpen our skills and improve our mindset and consistency over time. So this is a big part of my approach. This is one of the ways that I try to help folks really learn how to navigate the markets by using data to our advantage. And the most formative part of my trading journey was navigating through the great financial crisis. The COVID crash, don't get me wrong, that was quite intense, very short time frame, incredibly volatile pocket of market activity. But still, going back through those formative years, late 2007 through early 2009, that was one of the most incredible experiences for me because I was just cutting my teeth. I was just really learning how to trade, and I got to see the plumbing of the market and the economy, not just here, but abroad, really in full view, come apart, get put back together as best as they could put Humpty Dumpty back together again. But that was also what gave me a lot more, I would say, understanding of how important it is to have data to back your view, to be much more systematic, which is why I've really grown to appreciate the importance of these different components and how they all fit together. So let's talk a little bit about the markets and what's going on. Today, we had a day where the rally really focused on tech. There was some pretty significant weakness in industrials, utilities, real estate, healthcare, financials, even parts of the consumer defensive space. But tech overall, with some exceptions, did pretty darn well. NVIDIA had a powerful continuation of that Friday move above its 50-day moving average. We also saw some pretty powerful extensions in Meta, Google, and even Amazon, Microsoft, Apple. Some of the usual suspects were along for the ride. And of course, Broadcom continued that powerful rally that we've been seeing there. But it was a narrow market. And that is something that does amplify certain types of risk, particularly as we get into Q4 earnings season and we go through big tech's earnings. They really need to surprise the market to the upside. I did share a note with Traderade members on the Discord that we are looking forward to an earnings season that's supposed to be pretty robust, but there is some nuance here when expectations are very high. Sometimes that means if companies aren't really beating them handily, there is some more risk to factor in there. So that's just something to think about as we get into that Q4 earnings season, which happens in January, February, March, and so forth. We basically look back at what all companies were doing, what they're telling us during that period of time. It is likely we see some of these really stellar earnings stories slowing a little bit in the Mag 7 and growing a little bit in the Inglorious 493. That is a theme I think that could go on for some time. Now, checking in on currencies, one note that I shared on social and on the Discord was the dollar is getting stretched. I talked about some specific ways we could potentially take advantage of that on the Discord. One of those would have been looking at UUP put spreads, which have done pretty well. I think this dollar move may still have some room to move lower. I don't know that the dollar's rally is over. I don't think that it is necessarily, but it is healthy for it to have a sort of consolidative or corrective pause. And that's what I think we're in, because positioning has become extreme. And we'll look at that chart a little bit later. But the pound led these cross pairs higher in the majors, up about 0.9% today versus the dollar. Across crypto land, it was a bit of a mixed picture overall. Bitcoin did lead the way higher, though, back above that magical 100,000 number. So that's another one to keep an eye on, because a lot of the stocks that are attached to crypto, whether it's things like Coinbase or some of the miners like Mara or Riot, or some of the leveraged high beta Bitcoin shitcos like MicroStrategy, there's been a lot of emphasis in going back into this high beta space. Now, personally, my thought is if you're really bullish of Bitcoin, probably better to play it directly with Bitcoin than extrapolate it into some of the individual company risks that may be involved. But there are also some legitimate short squeeze opportunities in some of the miners. So if one is to want to play Bitcoin, I would be more excited about looking at some of the miners than some of the other companies, specifically because you have a lot of hedge funds that like to lean heavily short there. So if you want to play the equity, I'd look at the ones that are heavily shorted, that are, kind of trading without enough volume to cover the shorts in any even single week. Like if you look at Mara and Riot, some of these others where the short interest grows really, really high before these squeezes, typically what you're looking for is enough ammo on that short side to really squeeze it higher when you're getting those call-driven gamma squeezes in the options. So it kind of feeds in. You've got option speculators, momentum players, and hedge funds covering shorts, all driving price higher at the same time. So those are the kind of plays you look for when the longer duration risk assets like crypto are really getting bid. Look at crypto itself, look at Bitcoin proxies, but also look at the ETFs that may magnify those moves, or the short squeezes in some of the miners where there's a lot of folks that get caught on the wrong side of that. So just wanted to talk a little bit about that in terms of where I might want to express that view to see continuation higher. Now, in the broader market, we had a bit of a fake out day today. We did manage to stay above the 50-day and the 21-day. I look at the 50-day SMA or simple moving average and 21-day exponential moving average, and it is helpful that we retested the 21 and bounced off that a bit. It is helpful that we stayed above the 50-day, but I really don't like the pattern that we see here. Momentum is still in its sort of consolidative phase. We haven't had this decisive move higher. And one of the big areas, and we'll talk about why, is SPX 6000. If we can't decisively move above there on a closing basis, we're still caught in this sort of consolidative mud that leads to a choppier trading environment, particularly given that liquidity is still a little bit lower than where we would ideally want to see it. Now, if we look at the NASDAQ 100, certainly looks better than the S&P. It's above its 50-day SMA. It's well above its 21-day EMA. It did retrace some of its move today, but not the same way the S&P did. It's a little bit more constructive, and I think that has everything to do with the heat map. We saw the strength in tech. You can see that strength reflected in the NASDAQ as well in terms of today's move. Now, looking at some of the other indices, the Dow looks objectively terrible. We've had a death cross, so that in this case, 21-day EMA below the 50-day SMA, and we've had a sort of move above, try to kiss that 21-day EMA in rejection today. That tells me that the Dow still is in pretty precarious territory. So while the S&P looks like it's consolidating and the NASDAQ still looks pretty bullish, the Dow looks downright awful here. And it's joined by the Russell, which a lot of folks were hoping that the small caps would have this big move. I'm sorry, I've got the mid caps on screen. The next one's the Russell. You'll forgive me because these charts almost look exactly the same. Look at that. So On screen, MDY, midcaps, and Russell, same commentary. They both look pretty bad like the Dow. You've had that death cross of the 21 below the 50, and you've had this rejection of the 21 today. That tells me there is room for the Dow, the midcaps, and the Russell 2000 to potentially move lower here. They're looking pretty weak overall. So here's the Russell chart just for comparison. It's almost exactly the same as MDY, which is a little bit disconcerting that so many different pieces of the market, so many different factors are behaving similarly. Because then we look at this chart of the equal weighted S&P. Does it not look almost exactly like the Russell and the MDY chart? Because to me, it's very similar across all three of these charts. And we're not done yet, because QQQE has a somewhat similar look too. So what is this telling us? It's telling us that breadth still remains challenged. In fact, last month, monthly market breadth was on pace to hit an all-time low, and it did. So that's a concern because, again, you have this narrow risk picture. If any of those larger companies begin to meaningfully stumble, it can drag the market lower. So it means for us as traders, whether we're looking intraday or swing, all eyes on the Mag 7, on big tech, because they are leading this market right now. And we can see that in the relative strength of tech versus the broader market, in NASDAQ versus the S&P, the Dow, the Russell, etc. Tech is where you want to focus for right now because that's where the momentum is. The rest of the market, there may even be relative weakness opportunities for shorts against where there is relative strength. But at the very least, it makes sense to avoid the small caps, the mid caps, the Dow, and the equal weights until they start to pick up positive momentum again. Now let's look at S&P 6000. This is an enormous level on the options chain once again. I think it's going to be the decisive level as to whether or not we see upside continuation. We did flirt with it today. We were rejected. We also flirted with entering into positive gamma territory today. We were also rejected there. For me to become more constructive on a swing basis for the broader market, for the S&P, for even some of those other aggregates we were looking at, I need to see a push above 6,000. Because that'll also bring us into positive gamma. That'll get us to more probabilistic outcomes of upside continuation. No matter how you look at it, that 6,000 area is a crucial area to overcome. For now, it's a big wall of calls just overhead. We've knocked on it. We've sold down. That is typically what happens during those first attempts. We need to see how we do throughout the rest of this week. And we do have some pretty big event volatility catalysts like ISM, like JOLTS, and Fed minutes coming up. Another area that's interesting to look at is skew, which has come down quite significantly from its highs, which suggests some of those hedges that people had put on may have been cashed in. And that's part of what's probably helped the market find its footing, but it's also something that tells me there is some long positioning that's starting to come off. And if we look at some of the positioning aggregates, we do see that as well. So if we're looking at, just some of the measures of overall exposure to stocks, there is selling underneath the surface. A lot of the stocks that aren't the Mag 7, those factors, sectors, and individual stocks are seeing more distribution. So let's talk about the big picture here for a moment. This is the reason the Fed's really been cutting interest rates. If we want to be 100% honest with the overall situation, it's not like all-time high stocks, all-time high crypto, all-time high housing prices, all-time high prices in gold and things like that were a compelling reason to cut. And I'm saying that a bit sarcastically because the reality is the opposite. None of those things suggest a market that's under much stress. You also see there are other areas where interest rates are actually moving higher against the Fed. And that's on the long end, which we'll talk about in a moment, which sort of suggests Fed policy hasn't had the impact that maybe they would have wanted to see, which also tells you there's more concern about upside or right tail risk in inflation in the economy. That is to say, there's more concern in market participants that are trading bonds saying, you know what, the economy looks stronger than we thought it did, and inflation looks like there's more risk that it could come back or at least remain sticky than we thought it did. This has led to a couple of key developments, which has led us also to no longer be inverted. 10s are trading at higher yields than 2s. That means that bonds are also retaking the yield advantage over cash. So there is some duration premium there. typically you do see a much larger duration premium, as we can see from later 2020 all the way through mid 2022. Often there's a bigger premium, and the reason there's a bigger premium is because you're being paid for taking that duration risk, right? If you're lending the government money for 5, 10, 20, 30 years, you would expect to be paid a higher interest rate than lending them money for several weeks or months. And that's one of the reasons that there's typically this duration premium that is only now starting to come back to some degree. We've also seen long-dated yields at their highest level in more than a year recently, which is interesting because it does put some pressure. And it's not just the 30s, we're seeing this in the 10s, and this puts upward pressure on the cost of debt. There's a lot of global debt, about 100 trillion, that keys off 10-year rates. There's also a fair amount of US debt, including things like mortgages that key off these rates. So you're seeing the cost of capital coming up even as the Fed is cutting rates. So policy outcomes aren't necessarily what would be desired. I'd also say, as an important matter of nuance, that most Fed policy impact is felt on the short end of the yield curve. ING even goes on to say they could see the 10-year treasuries hitting 5.5%, a level that was only hit over 2 decades ago by the end of this year, which isn't entirely unreasonable if we see the economy remain firm and inflation show signs of not just remaining sticky, but accelerating. We did have a 3-year note auction today. It wasn't particularly well received. There was a bit of a tail. That was also one of the reasons that yields started to push up a little bit more, and the market saw some pressure after those auction results were out. So just something to take into consideration. I do believe long end yields start to matter again, particularly over 4.5% on the 10-year. Another area that is of concern is bank reserves are falling below 3 trillion for the first time since April of 2022. This gives you a sense that liquidity too is becoming more constrained. That is a concern. That is something that we should be mindful of. And this is a great little highlight. So we are now at the stage where a portfolio manager, or I would also interject a trader, must see liquidity as a dedicated fundamental of trading, and again, open paren or trading, close paren, as they do credit, risk, and volatility correlations. What this means is, even though a lot of folks that were investors and, in my own words, traders, were not necessarily carefully monitoring liquidity as a part of their risk management process, you surely need to do so now. It is really important. And as they say, it does add complexity. That's true. It absolutely does. But it's not about timing the market as much as it's about gauging your risk. If liquidity is drying up, as it is, and not just in the bank reserves, but also in book depth, and also in some of the other mechanisms we may use to basically get a better understanding of what market conditions look like, that tells us that what we need to account for is the potential of higher realized volatility. And that means position sizes, particularly for shorter term traders and leverage swing traders, needs to come down because stops need to be widened to account for that higher level of risk, right? So if you're a trader, it changes how you manage risk. If you're an investor, you need to be aware of what parts of the market may benefit and may not benefit from a lower liquidity environment. And I would argue that you may see some of the companies that have stronger balance sheets and stronger free cash flow benefit in an environment of lower liquidity, and some of the longer duration risk companies may be struggling, the ones that don't make money, that may have to dilute their shareholders and so on. That may also be one of the reasons small caps are struggling, because 40% of the Russell doesn't make money. So if we look at the financial conditions index from Goldman Sachs, we could see it is starting to tighten again. From December on, it really has been on a powerful impulse up move. And this is because primarily rates are coming up, right? So this is another sign that, again, we could be entering a more volatile market regime, or a market regime that could be a little bit less forgiving to high levels of leverage and concentration, particularly given the narrowness of what's pulling the market higher right now. Now, the other thing that this chart suggests is that manufacturing global PMIs could start to roll over a bit. Money supply also has a similar look as financial conditions, which is, it's similar. right? You're basically looking at various aggregates that give you a sense as to how much capital is sitting around ready to absorb assets. Right now, it is a bit more constrained, and that could correlate with some negative outcomes with global manufacturing, which also means potentially a bit of a slowdown in global economic activity. And that is one of our themes for this year. We don't necessarily look for an imminent recession on the horizon. I don't think that's a high probability outcome, but we are looking for slower growth, particularly here in the United States, where some of that fiscal impulse is becoming more and more rear view mirror stuff, talking about the Inflation Reduction Act and Chips and Science Act. But also we have a new administration. We have a Congress that's probably going to be a little more concerned about deficit spending. The interest spend on our deficit, or the interest spend on our debt, has become the largest part of our deficit spend as well. That's a concern. So that's something else to keep in mind, right? That we may not see that fiscal impulse be able to come to the rescue. And on the other side of it, the Fed has said, well, maybe we'll give you 1 or 2 cuts, but we're becoming a little bit more concerned about inflation stickiness and a little less concerned about labor because it seems to be more durable. And remember, the Fed has said in the past, that they were becoming more concerned about labor. Well, it seems like that's starting to change now, right? In the last meeting and in prior Fed speaker engagements leading up to that December meeting where they released their new SEP report and drastically downwardly revised the dot plot, there was a lot of conjecture about, well, we're not so sure. Things actually look a little bit stronger. Now, maybe you could call the Fed political, maybe not. Maybe the timing's just coincidental, but it was after those election results came in on November 5th, I believe, where that pivot really started from the Fed. Another area that's interesting, and I highlighted this on our Discord and on social media because I thought it was interesting, is dollar long positioning is becoming extraordinarily stretched here. And that is, in my mind, a sign that dollar longs are probably something to be more careful of in the near term. It doesn't mean the dollar has to imminently go lower and break its uptrend and all of that, but it does increase the risk of that. And we saw a bit of that today. Trump came out in the morning and said, well, I'm not actually going to change my view on the tariffs. They're still going to go through. And that kind of capped the lows on the dollar. We got a little bit of a retrace off those lows. I wouldn't be surprised to see it consolidate or correct from here, but I don't think the uptrend is necessarily over. I would just like to see a bit of a flush in positioning so that we have some of the weak hands shaken out, because that's really how trends take shape. Every once in a while, the market shakes out those weak hands and they have to come back and buy in, typically at higher prices. So when things get extraordinarily lopsided, like you can see they are right now with dollar longs, it has me looking for opportunities on the other side of that ledger and some of the cross currencies versus the dollar. And again, we talked about the pound. It'd be interesting to see if there's any continuation in that move. Today, it was up about 0.9% versus the dollar. If that continues, that strength could be an early momentum sign for a short-term long, a counter trend long, but one that takes advantage of that positioning rollout. And another area that's very interesting to me right now is Russell 1000, or large cap value. We are looking potentially for this shift over the course of this year from growth earnings to value earnings accelerating, and really kind of like a handing off of the baton, if you will. So as we get into the fourth quarter, they're almost neck and neck, and that's from value accelerating and growth decelerating. So if that ends up being the case, that does set up, because the markets are looking forward, for some potential long trades in higher quality parts of value. It doesn't mean just long value entirely, but maybe look at where there's relative strength in individual industries and sectors and companies within value. In terms of opportunities, I've shared a fair amount of investing opportunities and trading opportunities on the Traderade Discord, in the Trade Ideas channel and the Investing Ideas channel. Aisha has as well, so be sure to check those out. We're always updating them as we see opportunities on the horizon, and we believe there'll be many opportunities this year. So catch us next week, same time, same place, for Navigating the Markets.